So you said the Fed has 3 expected cuts in their dot plot that they released. Then you have the Fed futures market pricing in 6 or 7, but if you talk to an equity investor, they usually think it's somewhere between there, probably not 6 or 7. So how are you assessing risk there in terms of what's actually priced in the market in case the Fed does not actually come through with cuts?
This is a very important point about how those futures markets work. And it actually goes to like what's actually expected versus what's priced into the market. And when we say that, these markets, you can't take the pricing of the market for where the futures are going to be at the end of 2024 and say that's what the market expects. And the reason is these are not what we call unbiased estimates. People say if things go really wrong, they're gonna have to cut a lot. And so what ends up happening is it's one of the better hedges for things going really wrong. And so it doesn't mean that this is what people expect. It'll just bias the numbers higher because it's being used as this called a negative beta asset. So it's a hedge asset that people buy. And so what they actually expect may be exactly what you're saying, that it's somewhere, maybe it's 1 to 2 cuts that get priced in as a result of that hedge asset feature. And so you can't take it literally. You can't interpret those numbers literally. You have to price some of this hedge asset feature to it. But one of the things that we think people also miss on this pricing of the futures is people say if we don't get the 5 to 6 cuts, we're going to be really disappointed and the equities are going to sell off. And we say that's completely wrong. We say we could actually have a good market if the Fed does nothing. And the reason they're going to do nothing is the economy is actually strong and earnings growth is probably going to be strong. So you don't need the 3 to 5 cuts to actually have a good market. I mean, yes, it's priced into the market today, but you say under what scenarios are they not cutting? It's because GDP growth continues to be robust. They're not really laying off people. Productivity is coming fine. Margins are coming fine. And so you'll probably have a pretty decent earnings outlook, and you'd still have a reasonable market under that scenario.